Hello, TCMS. Mrs. Martin here. Great job, everyone who's already submitted their version of the financial plan for Greg. Um, I'm, I've already seen some of them, and I will be leaving some feedback on those sheets. But here's the gist of things. Okay, here we've got an adjusted plan, and the rest of the year filled in, assuming Greg kept track of his spending through December. So, in my opinion, that's the hard part about this whole financial planning, trying your best to keep track of what you're spending and in what categories those expenditures are happening. There's lots of apps out there that do that for you. I believe even some of our bank apps are starting to do that now. Like Bank of America has one where it tells you what categories you've been spending in, assuming you're using your card and not cash. So just be on the lookout for those kinds of things. They can become very, very helpful. Let's start by looking at Greg's income. And remember, this is all just for pretend, so I entered some numbers. Greg's wages stayed pretty consistent until December. Maybe he got some Christmas bonus or holiday bonus around that time of year. His tips, it looks like they went up over the summer. Maybe more people are eating out because they're on summer vacation, but then they start school, so that those tips drop significantly because not as many people are eating out. So lots of different reasons, but here he's tracked tips. And then finally gifts. So he got the 100 for his birthday in April, but then nothing was going on in here until December. Maybe some Christmas or holiday gifts, Hanukkah, Christmas, Kwanzaa, whatever you're celebrating, he got some gifts for the holidays. So here's kind of the review, the year or half year in review for Greg's financial plan. Moving along, let's look at his debt. There are a few important things to see here. First of all, Greg put a lot of focus on this Visa here at the top, right? He paid the minimum on the Target card, and he put really large chunks on the Visa. Now that might feel a little counterintuitive. Some of us might have been tempted to put a lot more money on the one with the 5,000 principal amount, that auto loan. We want to get rid of the 5,000. But let's switch over to Desmos here and look at what those graphs look like. So when money on credit cards is growing, for the most part it's continuous. Depending on the rates, it could be a little different, but I just went ahead and used PERT. Those of you who are doing econ, you know PERT very well. And I put in the different principals with the different rates here in Desmos, just to kind of see how those are growing. Now, obviously, your finances won't really look like this because there's the assumption that you're paying monthly to pay off the card. But assuming the cards were left alone to just grow on their own, notice that although 5,000 starts up higher, that's the auto loan, although it starts higher than the rest, it's not growing as quickly, okay? It's taking a lot longer to increase significantly. The green one, which is our Target card, is even lower than the auto loan. Okay, it starts slower and it's growing slower. So again, Target card, although we're still paying the minimum because we don't want to default on those accounts, we're not as worried about that one. We can pay the minimum without really stressing about it. Our focus here is going to be the Visa and the MasterCard, and that's because you can see with the red and the blue that not only are they starting out at a significant principal, but that they're also growing the fastest here. And so if I ignore those, or if I'm only paying the minimum, I'm really setting myself up for failure here, because these things are just going to be growing exponentially, literally, and it might start to hurt us in the end. We're going to be hit with a lot of interest. Okay, and again, this growth is based off of just the interest, not even the fact that you might try to use the credit card on something else. So be aware of rates. Rates are important. So the higher the rate, the faster the growth. And so as we can see here, Greg went ahead and put his focus on that 21% Visa card. As much money as he could throw down on that card, he did. So he can try and get rid of that debt first. As we continue looking through this financial plan, I just want to point out that Greg has decided not to use those credit cards anymore. Okay, we are on a mission to get out of debt, quite a significant debt at that. So just moving forward, remember, Greg is not using these credit cards because he's trying to eliminate them. Quick note about that though, when you have credit cards and you are determined to pay them off, once you're done paying them off, don't close them, okay? Credit cards help you build credit to your name, and your credit score increases the longer you have an account open, because it shows that you are dedicated, it shows that you pay those accounts off, it shows that you are trustworthy when you are borrowing money, and that's why your credit score goes up. If you close that account, then all that history that you've built with that credit card will go away. It is deleted from your credit history because you have deleted the account. And so essentially you've deleted all of the history that you've built up paying off that account. So just a heads up out there with credit cards, if you've got one and you decide, you know what, I don't want to deal with this whole debt thing anymore, I don't want to accidentally, well, not accidentally, but inadvertently spend $5,000 or $2,000, whatever your credit limit is, my suggestion for that, and again, everything that I'm saying in these videos, they are suggestions. It's not that there's a right and a wrong way. You know, there's lots of different ways that people approach their finances. These are just some suggestions from your math teacher of what's worked for me. Okay, one thing that I've done is to keep the credit cards open, but without them becoming a burden, I would assign, for example, this Visa with a very unfortunately high rate. I'll assign that Visa to my Netflix account so that it pays automatically. Netflix is only what, $15 to $16, and I can pay that back monthly. The card doesn't close because it is getting used, but I'm also not building a ridiculous amount of debt because I'm only using it on the Netflix account. Okay, so that's just a suggestion. And now let's move on. Okay, so let's keep looking at the debt. This MasterCard, 18.5%, also pretty high. So Greg's putting a nice chunk down there. Target card, the principal isn't a lot. He doesn't have a whole lot on that card, so he's just paying the minimum. And then the auto loan, that is a large principal, a large starting amount, but Greg's just going to go ahead and pay the minimum on that too, because he's not as worried about that 10%. 10% is pretty low. Okay. Moving right along, notice that in the plan, Greg has significantly reduced his original plan for the emergency fund, retirement, vacation, and down payment on a condo. Okay, first of all, remember that Greg is a college student in this story, so retirement, although he's looking ahead and knowing that he needs one, he doesn't feel like it's crucial in these first 6 months of his financial plan. So he's still going to put some money down, but he's not going to put a lot because it's not like he's trying to reach $100,000 on his own. That retirement account actually should have a percent on interest as well. Okay, so again, that's another topic that we could spend loads of time on talking about, but since you're all young, you still have a little bit of time, but as soon as you can get information on retirement plans, get that. Ask somebody to explain it to you. Talk to the banks or to your employers about your retirement plans, because the sooner you start, the more money you'll have when you retire. Okay, so again, topic for another day, but notice that Greg, although he's still paying attention to it, he's not putting a whole lot of focus on that. That includes his emergency fund, vacation, and down payment on a condo. When taking personal finance, one thing that I was told is that it makes no sense to have savings if you have debt. And what I mean by that is, if I've got this big old savings account that's sitting there and making maybe 1 to 2%, okay, if you've taken some time to look at some banks and their percent interest on savings accounts, you'll notice that most big financial institutions aren't offering a whole lot on a regular savings account, okay? So if I'm building 1% or 2% on my savings account, and those of you who look at your bank statements, you'll see like pennies on interest, that's not going to compensate for this 20% interest that's building on the credit cards. That's money that I'm losing. So if I've got money in the savings account and yet here I am building a bunch of interest off of these huge debts that I've created, then really I'm doing a disservice to my financial plan. So with that in mind, that is why Greg has put more focus on paying off debt than his not debt goals. Okay, so there's that as well. So really, debt and savings work around something called time value of money. Now that's another thing that would take a little more time to understand. I can post slides on this topic in case you're interested. You should have more in-person support on, so feel free to look at the slides, but if ever given the opportunity, try to find out more about time value of money, and that refers to just how your money is being affected by the progression of time. So before we move on, I have heard some suggestions about paying off the smaller accounts first. Okay, so our strategy here with Greg's plan is to pay off the accounts with the high interest rate, because those are the accounts that are growing the fastest that we would like to kind of take out before they keep causing us trouble. But there has been suggestions that I've heard of in the past where we pay off the smaller credit cards with the smaller principals, because once we pay off those accounts, which are a lot easier to pay off, this one has $600, so maybe we can address that first. When you pay off a credit card, it's a really great feeling. Okay, so for some people, they prefer to pay off the small credit cards because they feel the accomplishment and it really pumps them up to keep paying off other cards. So that's another route you could take. Again, lots of right ways that you can go about planning with your finances. Okay. So notice how as months go on, we actually knock out the visa fairly quickly, which is great. So again, this is filled in with a hypothetical situation. In May, Greg goes ahead and pays his $565 that he had planned. He does the same thing in June. And by July, there's only $70 left on the account. And notice over here that the total now matches the account because he has paid off the visa. Okay, so that's great. Greg was able to finish a debt account, and now maybe he can take the suggestion where he just assigns it to a Netflix, and then it'll stay open so he doesn't lose his credit history, and he can just do little payments on that on a monthly basis. And so now he doesn't have to worry about that one. And in August through December, he's got $565 he no longer has to pay to the visa. Okay, that money can now be sprinkled around the rest of the spreadsheet, and we'll see that it is as we move along. And so we see that in the MasterCard. Once he stops paying the $565 in July, it looks like he threw some extra money down onto the MasterCard, because now our sights are set on taking out that MasterCard because it's the next highest percent. Okay, that's the strategy that Greg is going with. And again, he pays the $350 all the way through to November, where November he's got 100, and that finishes off this account. So now December, he's free of the MasterCard. So within 6 months, he has now made himself free of the $1,200 on the Visa and the $2,000 debt on the MasterCard. Okay, and now that he's got 2 of these done, he kind of finishes mostly in November. Again, he's able to throw some extra money on the next card of highest interest. That's our Target card, and we can pay off there. And finally, once he's got extra money again from the MasterCard, it looks like he pays a little more towards his auto loan. So again, looking at this is a very basic way of looking at paying off cards, because again, even though he's paying money here, he's still getting interest in May, June, and July, and that's where that time value of money thing comes in. So in the long run, he won't be paying $1,200, unfortunately. It'll probably be a little more because of interest. So we're just going to go ahead and not worry about time value of money for now, and just focus on the basics, okay? Now let's go ahead and look at Greg's expenses, okay? So many of you, when I was looking at your pages, you cut in these areas. So areas like cable, Maybe cable was replaced by something like Netflix or Hulu or Disney Plus or any of the bunch of other movie and show streaming applications that are out there. Maybe you don't really need the 1,000 channels on cable. You're perfectly satisfied with Netflix and Hulu and Disney Plus and Quibi and all those other ones. So you went ahead and cut in the cable section because you didn't really need all that cable. Okay, and then also maybe you cut your phone bill a little bit. Okay, some of us cut our phone bills because you can withstand a data cut and use Wi-Fi more. Okay, with Wi-Fi now, maybe you don't need the phone plan with unlimited data. You can get Wi-Fi at home. You can get Wi-Fi at Starbucks. You can get Wi-Fi at Kaiser and at school and all sorts of other places with free Wi-Fi. So you can go ahead and cut data a little bit perhaps on your phone. In addition, maybe gas we can cut a little bit because perhaps you decide to create some sort of carpooling situation with a friend and you get to pay less in gas. That would be a good place to cut. And with all these cuts, I was able to take that extra money and put that money towards those debts at the beginning. So keep those in mind. Certain things like insurance, there's not a whole lot you can do about insurance. You got to pay those. Utilities, often that's pretty stagnant. Whatever you're paying at home for water and power and gas, that's pretty stuck. Groceries, same thing. It's not like you can stop eating and cut your groceries. So groceries usually stays pretty consistent, and you can see that along in our table here. Entertainment, that might be a place you can cut to, but again, looking back at our A Penny for Your Thoughts article, remember that your money, you work hard to earn that money. So you deserve to spend a little bit of that on yourself as well. So we didn't really mess too much with the entertainment section. We still want to be able to monthly have some money to go out and eat with our friends or make a trip to an amusement park or something like that. So entertainment and those extracurricular activities, we made sure to leave us some money because we're young and we deserve it. So that's there as well. Looks like Greg did some extra stuff in October. Maybe he went to Knott's Scary Farm. Knott's Scary Farm is fun. So once again, this is just an example with a whole lot of suggestions, but you may have many options out there. And there are a lot of pretty spreadsheets for financial planning. This one is a very basic one, but it works for us right now. The whole purpose of the financial plan is to become more aware of your spending. And typically what we should be doing is every 6 months to a year, after I'm done with December, so you're in winter break, say, and it's after Christmas and Hanukkah and other holidays that occur around that time, it's after New Year's, it might be a good time to sit down and reevaluate the plan. Go through your debt and change these numbers because now hopefully they've been significantly lowered. Okay, reevaluate your monthly plan. Maybe now that you're not paying the Visa, that $565 could be going back towards the down payment on a condo or a car or whatever else you add in here. Okay, so again, I've posted a blank copy of this sheet so that you could have that with the fix on this row because again, this formula was a little bit off. I had a 27 here instead of a 17. And notice that in Greg's plan, he got really green here, which is nice. He made some surplus, and where should that surplus be going? Hopefully to debts, and if finishing off debts, you can start putting them towards your financial goals. Okay, so now that he's making so much extra green here by December, this is where we need to start going back and reevaluating what our monthly plan should now be. Okay, all right. So if you have any questions, as usual, feel free to post them in the discussion. And that wraps up our work in TCMS. I'll be sending this message out in another video, but for now, I really hope you learned a lot and that you're taking with you the experience of critically thinking and tackling branches of mathematics that were very, very new to you. So as you go out into the world, know that this ability to learn and reason will serve you well forever. So until next time, bye.